What's up, everybody, and welcome to Let's Talk Markets. I'm Pink, and I'll be your host along with my co-host, Dave Lauer. This week, we're going to talk about the discussion that Dave had on a Twitter space with Gary Gensler, where they covered things like the WTI petition, some SEC proposals that are coming up that have some really interesting new changes that would come about, like T+1, why not T+0? We're going to talk about settlement times and all of that. Straight through processing, if we have time to get to that, and some other things that Gary mentioned in that discussion. But I will just hand it on over to Dave here. Dave, how are you doing?
Hey, I'm good, Pink. Thanks for co-hosting with me and talking markets. It's always fun. Usually it's just, me shouting in the mirror. So it's better with someone here and people actually interested in listening to it.
Yeah, or kind of yelling into the Twitter void, right? It's nice to have it sort of focused, which actually I saw something interesting on Twitter kind of before we get into that. You were talking on Twitter today, and I saw something from Alex Gurko too that it's kind of funny. Do you want to touch on that?
Yeah, so it gets into our conversation about these new rule proposals from the SEC. So yesterday, the New York Stock Exchange, Citadel, and Schwab, a retail broker, came out and they said, we agree on what should be done with markets. And they basically proposed the bare minimum changes that you could make. And then they said the SEC should withdraw the proposals for the ordered competition rule, which would take all of these orders from individual investors and push them onto stock exchanges out of the wholesalers and out of Citadel and Virtu. And as well, the best execution proposal, which, while I don't think much of it, apparently these guys do. And so maybe that makes me rethink it a little bit.
Yeah, maybe it needs a second look, huh?
Yeah, maybe it is worth a second look. But the main thing that the best execution proposal would do that's very different from today is it would define something called a conflicted transaction. And it would say that you have a larger burden if you are engaging in conflicted transactions, which is all Citadel engages in with Schwab. They're all conflicted transactions. So what was interesting about this, and what Alex Gurko is alluding to, is that the New York Stock Exchange should very much be in favor of the order competition rule at a minimum. I mean, the best execution rule, that's something different, and we can talk about why they might not be in favor of that. But the order competition rule would be seemingly a bonanza for the New York Stock Exchange. And it's something that the New York Stock Exchange has been pushing for well over a decade now, which I talked about on Twitter. I talked about this fellow, Joe McCain, who used to be at the New York Stock Exchange and is now at Citadel. And when he was at the New York Stock Exchange, he and Michael Blaugrund, who is the signatory to this letter from the New York Stock Exchange, we're both quite adamant about changing market structure to eliminate this massive amount of off-exchange trading in wholesalers like Citadel and Virtu. They've testified before Congress. They've met with the SEC on multiple occasions. They each have met with, well, at least Joe had met with me on many occasions when he was at the NYSE, talking about how to work together to push for a trade at rule, which would be, we can talk about that as well in a bit, but that would be a better version, I think, of the order competition rule. And that would push all of this trading that's happening at Citadel and Virtu, and this whole pipeline of productizing and monetizing individual investors' orders. It would push that pipeline out of the dark markets, out of Citadel and Virtu, and onto exchanges. So you would think, well, wait, why would the New York Stock Exchange be against something like that, being that they've been pushing for it for a decade, and being that just last year in October, there's another tweet that I put out where Michael Blaugrund was specifically talking about auctions and how good auctions are and how well they work, and why that's a really good option here for the orders from individual investors. And so Alex Gurko comes along, and I think it's hilarious what he posted where he's like, it's a nice exchange you got there. It'd be a shame if something happened to it.
Yeah.
It is. It's such a mafia thing.
It really is.
Going on right now. So
they're a bunch of thugs there, just intimidating their way through.
People need to understand that Citadel is the New York Stock Exchange's largest customer, right? That's sort of the key piece of information here. And Virtu, one of the largest customers of these exchanges. And so exchanges are in a tough position. They can't be seen as coming out for things that would harm their customers, even if those things would help their shareholders, and even if those things are good for markets. And so it's all very confusing and complicated. I mean, maybe to most of the listeners on here, they're like, no, this is very simple. It's, they tend to be very reductionist about it. And I don't blame you on that. There's something clearly going on here. But the New York Stock Exchange is not just a company. They're a self-regulatory organization. That is a responsibility. They have a responsibility that is supposed to transcend profits and revenue. They have a responsibility to maintain fair and efficient markets, to police their members, to pass and enforce their rules. That is the nature of the self-regulatory system. And I'm not here to defend it. I think it's a terrible system, but that's neither here nor there. That is the system we have today. And self-regulatory organizations have immunity from liability because they are considered quasi-governmental. They are extensions of the SEC, extensions of a government agency. And so here you have, this SRO coming out, self-regulatory organization coming out against what they have said for years would be the best thing for markets, because they need to.
It makes you want to pull your hair out, right? It's like, what direction are we even going?
Like, Citadel and Schwab. And you have all of these people involved who have said the exact opposite thing for years than what they're saying today, which is, what I tweeted about as well. It's just pure hypocrisy. And it really is something that, what we can do, we can put it on the screen, another tweet that I posted a couple days ago, which was that the way I see these things is that the chair of the SEC, Gary Gensler, just completely sees through all of this at this point, and he just doesn't care. And I think that is, again, one of the most important things I've seen happen in my time in all of this. He went to a Bloomberg conference, and before he came on, there was a panel, and the panel was a bunch of different firms, and those firms generally agreed that these proposals were doing too much, and that we should, that the things should be different, that we should tone it down, we should take it easy, all of this, slow it down. And so then Gensler came on, and someone asked him, after seeing those firms who generally don't agree on much, agree on all of this, does that make you reconsider what you're doing here? And he was like, no. Which is perfect. And he said, he's like, the SEC has a responsibility to 340 million Americans. These firms have a responsibility to their P&L, their profit and loss. This is all about revenue for these firms. So we are here, we are listening, we are engaging, but, do a bunch of self-interested firms change my mind on what's right for markets? No. And I think, honestly, I'm not often inspired by SEC personnel. No offense to SEC personnel. You're all, you're doing some tough work and all. But I was blown away at the whole thing, that it's just saying the quiet part out loud.
Yeah.
And so this was.
And saying what we're all thinking, that part of the 350 something million investors are all thinking too. And it's like, hey, he said the thing.
Yeah. And look, I hope we're having some influence. I hope he's starting to see that he has the backing of a lot of individual investors, that these rules have broad support, and he said it many times in our talks with him that, the only way these rules are going to pass is if individual investors have their voices heard and get in there and comment. And, so we can talk a bit about that too. But, I think honestly, this was a real interesting week for market structure. We're going to have a lot more because, this is all going to continue to unfold over the coming months. But, some people are really kind of throwing the gauntlet down. And I think the SEC did as well. And my understanding is that at this point, A lot of these firms are not expecting any material changes to the proposals. They think they're mostly going to pass as is. I don't know if that's the case, but I do think that that these proposals will pass in a form that we're happy with. And frankly, like the form that they're in now, we're mostly happy with, but they could use some changes. And then it's going to go to litigation, and these firms are just going to sue the regulator. And then, on the one hand, that's unfortunate because it will delay the rules, and it means that it depends what kind of judge you get in terms of the success rate. But on the other hand, it's a pretty high bar to successfully sue the regulator and to argue that these are arbitrary and capricious because they are so well supported by economic research. So, I would still be very optimistic in terms of their chances of being approved. But this is going to be a fight. It's going to be a long fight. It's going to continue. And I think there will be ample opportunity for individual investors, not just in the comment file, but as these things go to court and litigation, to have their voices heard as well, through supporting briefs and amicus briefs that will help spearhead, through We the Investors and through Irvin. So, I think this is, these are wild times, that's for sure.
It is. And then we kind of touched on it before in the previous episode, so I don't want to harp on it too long, but that really highlights the importance of persistence and staying at it. As far as market reform and advocacy and trying to change these things, it's a never-ending job. It's not just making those changes, but maintaining those changes, making sure that they're enforced, making sure that they do become rules. So, so what do you think about those proposals? Like, which one stands out to you the most? What's the most important aspect I think that you took away from these proposals, and what do you think that retail investors should be focusing on from that?
Yeah, so there are 4 proposals. The first is an update to Rule 605, which is venues have a disclosure responsibility where they have to disclose execution quality on the venues. It's an update that is, a long time coming. I mean, that rule was passed in 2001. I've been pushing for it to be updated now for 11 years.
Wow.
It's finally happening, so that's exciting. But it's not a very controversial one. Nobody's opposed to it. There might be some details that some commenters put in there. I still, honestly, I haven't even spent time thinking about it because the others are much more important, but I will before the end of the comment deadline. But it's probably not something to worry about too much. And then the other 3 rules are far more significant. The first one, which seems to have a little less opposition to it, are updates to Reg NMS. So it would update the tick size, tick and trade increments in markets and bring them down from 1 penny, which is what they're at today. So when you put an order into the market that goes to an exchange, you can only put that, you can only specify out to the penny, out to 2 decimal places, what the price on that order should be. Now that's also true for when you put an order into your retail broker and that's sent to a wholesaler, you can still only put it at the penny, but it can get filled out to 4 decimal places, which is not really something that can happen on exchange outside of some very specific facilities on the exchange. So they're looking to update that. The actual updates that they want to do to tick and trade increment are controversial. They want to bring, for the most tick constrained names, they want to bring it down to 10 mils or 1/10 of a cent. I think that's too much. I think that's way too tight, too small of an increment. I'll be on the camp that says half penny is good. Maybe 1/4 of a penny. We'll see, or at least you can trade at 1/4 penny because you can trade at the midpoint. So, that's one of those things where the industry is going to have a lot of thoughts on it, and we're going to try and put together something that's in the best interest of markets for the tick and trade increment. But really important to that is that, and this was in the Citadel and IZ Schwab letter, that they agreed to tick and trade size harmonization, which is to say that now exchanges and wholesalers will be subjected to the same rules on tick and trade increment. That would be a big deal because up until now, the wholesalers have had a regulatory advantage. This is what happens when Bernie Madoff helps to write the rules.
Yeah, talk about it.
Some things in there that you wouldn't want in there, and this is one of them where wholesalers have had that advantage over exchanges, and that's part of what's driven all the off-exchange trading is that regulatory advantage they have. It's not a level playing field.
Right.
The next thing in the Reg NMS update is called the access fee cap. So today there's an access fee cap as part of Reg NMS that says exchanges cannot charge more than 30 mils a share for fees when people go to take liquidity, when they go to cross the spread with an aggressive order. And that's 30 mils, 30 cents per 100 shares. And again, that's pretty outdated, and it's a major factor in market complexity. So you have extremely complex exchange fee structures, and you have rebates on exchange, all driven by the access fee cap. So all the rebates go very close to 30 mils because the 30 mil cap is like a government price control, and that's what happens with government price controls. And so it really distorts markets, it distorts order routing behavior, and it leads to exchange fee structures that are so complex that they're almost impossible to describe and discern. So I don't have it in front of me, but RBC did a study a few years ago, and we're going to cite that study in our comment letter. And it showed that there were over like 1,000 possible different fee paths and fee combinations on exchange, and they're just completely incomprehensible. And they lead to order routing behavior that is suboptimal because brokers route orders based on fee minimization rather than execution quality. So they're talking about bringing the access fee cap down to 10 mils. And what we're going to say, and we're writing a comment letter that will apply both to the fee cap in the Reg NMS proposal and to the best execution proposal. So that's something we're going to probably file in two comment files for both proposals. And what we're saying is this is all crazy. Just get rid of rebates, get rid of payment for order flow, and you get rid of the fee cap. You get rid of the government price control. There's no need for it. You let competition, figure out exactly what prices should look like. And there are no more distortions in order routing behavior. So that
sounds a little bit like the mess with even just buying an airline ticket. You have all of these added fees and everything that it's like, what is truly the cost for me to travel here?
Yes,
what is padding your pocket? So
exactly. The airline industry and their loyalty programs are often held up as, examples of problems that markets are following.
Yeah.
It's a huge problem. And then the last piece of the Reg NMS proposal is there were some updates to market data infrastructure that were part of what was called the Market Data Infrastructure Plan, which were supposed to be in effect by now, but haven't been because the exchanges are in charge of the Market Data Infrastructure Plan, and they're going as slow as they possibly can because it means a lot of money that they'll lose a lot of money. So they're just dragging their feet. So the SEC is accelerating some of that, including odd lot quotes into the public feeds, which would be really important, and also changing the definition of round lots so that as stocks become more expensive, the definition of round lot changes, so it's not always just 100 shares. So that's the Reg NMS proposal. The order competition rule is the one that would change the way that retail brokers route orders, and it would say that unless a wholesaler is going to execute an order at the midpoint, that order has to be routed to a competition, an auction facility, competitive auction facility where it's competed over order by order, and that those are run on exchange. And so that would move orders out of Citadel and Virtu and on exchange. That is by far the most controversial of all the proposals. It's going to be the one that catches the most heat. And we're also writing a comment letter for that. And our comment letter is supportive of the proposal, but critical of it. It's an improvement to how things work today, but it is not as good as it could be. And I'm a believer in a trade-at rule. I think that is the simplest way to solve this problem, and it will have the least unintended consequences. So when regulators get involved in anything, the thing you're most worried about, generally speaking, is not just when they pick winners and losers, which is a problem, and they've always picked the wholesalers and the retail brokers up until now. But it's the unintended consequences of them trying to regulate a complex system, which is what our markets are. And so the order competition rule, in mandating these auctions, they're very prescriptive that the auctions have to be between 100 and 300 milliseconds, and here's all the data that has to accompany the auction messages, and here's all the rules around it. I just don't like that approach. I think it's dangerous. And I think that they're going to catch a lot of heat for it. It's going to be far more controversial than had they proposed a trade-at rule. And what a trade-at rule says, which is what you have in Canada and Australia, is simply you cannot execute off exchange unless that execution receives material price improvement. And material price improvement is defined as a full tick if the spread is more than a tick wide, or it's at the midpoint if the spread is a tick wide. And that's it. It's a two-sentence
Seems fair
rule.
enough, right? Yeah, I mean, that seems simple enough.
Very simple, very straightforward. And then if exchanges want to build auction facilities for retail orders, more power to them. It gives them flexibility to innovate. It gives them the flexibility to compete. It means that there will be on exchange open competition for order flow. It means individual investors and institutional investors will find each other and they will both benefit. There will be less intermediation, less high-speed speculation, and that's a good thing for markets. So, that's what we're going to say in our comment letter, and I'm very excited for that one. That's been something I've been working on for a long time, and I love how it's coming together, and I think we make a really compelling case. But it's not a guarantee. Like the SEC might still go ahead with the retail auction idea, and if they do, we'll also give them a bunch of suggestions for reducing unintended consequences and increasing flexibility for the proposal. And then finally, the last proposal is best execution. This is the SEC taking on their best ex rule. This is, Chair Gensler's talked many times how surprised he was when he found out the SEC didn't actually have a best ex rule. Today it's FINRA that enforces best execution on brokers. And there's a lot of thought that maybe the SEC would be less conflicted and would, have more resources for enforcement. For the best ex rule proposal, I don't find too many issues with it. There are a couple of small things that I think that can be fixed, really kind of focused on institutional investor issues and RFQ systems and all of that. They're relatively minor issues in the best ex rule proposal, but the major issue is, like I said, it defines this thing called a conflicted transaction. And it says if you're engaging in conflicted transactions, which is all retail brokers do when they send orders to wholesalers, you have a much higher burden for proving that that was the right choice. And you have to evaluate every other possible destination in order to prove that you made the right choice. Now, it sounds good, but to me, having worked on best execution for a long time, having worked with institutional asset managers and brokers on best execution, I think it ends up being a check the box exercise, and it doesn't actually make a material difference. So again, this is why we're saying, forget it. Don't do all this. We don't need all this for conflicted transactions. Get rid of the conflicted transactions.
Yeah.
Get rid of payment for order flow and rebates, and all this goes away. It's very simple. It's been done in most other jurisdictions around the world, and it just doesn't seem to make any sense why we can't do the same thing in the US.
I think there is like an element of enforcement theater happening. I think a lot of people have that sentiment that, this is really just, when you were talking about the best ex rule, I immediately was thinking about municipal contracts and how they contract labor out and contract, different jobs and things out. Sounds very similar, and everybody knows that's a super easy system to game. You just have to know somebody, and then you're around that rule. So it is a good start, but you want to make sure that it's not just lip service happening, that there's some teeth in there behind those lips that will actually enforce some things.
And it's a good example, right? Like in that situation, the city could get a good deal, right? But it might not get the best deal that it could have gotten through open competitive bidding process. And it's the exact same thing here. You can get good enough execution, but you're not necessarily getting best execution. And that's the standard. And it's the standard we should want. And so we need to get rid of this good enough execution. All of the comment letters we're going to see from, these high-speed middlemen and their enablers, the retail brokers, are going to talk about all the price improvement retail gets and how retail's never had it better and US markets are the envy of the world and all that. And it's, it's all platitudes and empty claims with no data. And the data that they do produce is often manipulated and gamed. We're going to show that in our comment letter. I think we're going to have a real in-depth exploration of several studies that really support our points, as well as, looking at the SEC studies. The SEC provided a lot of great data in the rule proposals. And, I think a lot of what they've done, the work that they put in here, And so, I think there's a lot of good stuff, and I'm pretty optimistic on the near term in terms of getting these rules into a state that we think they should be and getting them passed and finalized. Then it's sort of anyone's guess what's going to happen when it goes into litigation.
Right. And it sounds like a lot of this is happening more on an institutional level as far as what it will really affect in action. But I mean, that trickles down and definitely affects us all. If you're invested in our markets, then what affects the institution eventually affects us.
I mean, I know that people don't always like to hear it, but institutional investors are retail. Like the wealth of American savings and international savings are in mutual funds. They're in pension plans, right? Like we need to optimize markets, not just for individual investors, but for institutional investors as well. And we can do that when we decide that our markets are here to serve investors and issuers. We design markets in a certain way. When we decide markets are here to serve middlemen, then we do things differently. And that's really the point that we're at here, which is that it's a philosophical orientation towards designing markets for investors, both individual and institutional, and making sure that we're putting these things into place to help both of them. And unfortunately, that means that the speculators and the middlemen and the retail brokers are they're going to suffer, because that's really not what markets are here for. And for too long, they've wielded the influence of rulemaking and been the ones really writing the rules.
That's a really great point too, and I want to make sure that we touch on that again. That institutional investors are retail. That's
yeah.
As a millennial who was part of the whole Reddit meme stock movement, or whatever you want to call it. We're a new wave of investors that are doing it through our phones. We're doing it through our own brokerage accounts. We're not going to our brokers or anything like our parents did. We're not going to a financial advisor or anything. So when I think about my grandmother's retirement or my parents' retirement, they didn't hold that themselves. They didn't control that investment themselves, but that was still their money that they worked for through their entire career, invested institutionally. So that's a really good point, that we need to make it for everyone. We've got to make it fair for everyone across the board.
And you need to remember, right? Like we're on the verge of the greatest wealth transfer in history as the boomers, transfer their wealth to later generations. And a lot of that wealth is in mutual funds, and it's in, those other institutional investments. And it's important. I don't believe that these rules will harm individual investors. I believe they will help individual investors, and they will help institutional investors. I believe there are rules that are win-win for investors. They're just, it's the intermediaries and the middlemen and the rent seekers that will lose out. And frankly, that's what everybody should want.
It sounds like liability and transparency is really at the heart of what's being proposed here, is to just step up the liability that's happening on every end. And like you said, that goes more towards that side. No wonder they have such a strong opinion about it. And
that's right. I mean, it threatens billions of dollars at these firms. And so they're going to do everything they can to delay and postpone as long as possible. But, it's really hard to argue against open competition for order flow. That's the argument they're making. So that's why I think we're on the winning side.
Absolutely. We just have to continue to make our voices heard. And that is, you've made it really easy through We the Investors and these proposals that you can sign. Petitions that you can sign to become, a speaking out part of what's happening. And we'll be dropping some links to that in our info and our description and everything. We'll make sure that everyone has access to the We the Investors. So I think we've covered a lot this week. That kind of brings us to the end here, but that's a lot to digest, and I'm feeling really good. Like you said, I'm feeling a lot more informed about what's happening here. So thank you, Dave.
Sure thing. Yeah. And, we're going to have comment letters out. They might already be out by now, depending on when we post this. And we'll be pushing everyone to file those comment letters or write your own, and, take from ours what you can and what you want and what you agree with. But, the most important thing is have your voice heard, either by filing one that we've written or filing your own. It all helps. It all counts. And at the end of the day, you want to make sure that your voice was heard, because as Gary Gensler said, you can be sure the industry is going to make their voices heard.
Absolutely.
And we need to make sure that the other side is represented.
Yeah, we can be louder for sure.
For sure. That's right.
All right. Thanks, Dave. Thanks,
All right.
everybody,
Thanks,
for tuning in. And we will see you next week on Let's Talk Markets. Bye-bye.
Bye.